Good afternoon, everyone, and welcome to today's LinkedIn Live event, which is Has Europe Lost Its Way? My name's Karen, and I will be moderating today's session. So let me start by introducing our guests, Marie de Vos and Koen de Leus. Marie de Vos, a renowned academic, columnist and expert in European affairs. He is the founder and the CEO of the Itinerary Institute, so you have spent years and years researching and analysing European and domestic policy and trends. He is also the author of the recently published Superpower Europe, the European Union's Silent Transformation. So I guess we're really right in saying that we're very lucky to have you here to share your insights with us today.
Very kind introduction, thank you.
Next we have our very own Koen de Leus, Chief Economist at BNP Paribas Fortis, with a career spanning over almost 3 decades, I've been told.
Not yet.
Not yet. Koen has developed a deep understanding of economics and finance. He has written several books on the subject, the latest of which is, of course, The New World Economy. So his unique perspective on the intersection of economics and finance will undoubtedly enrich our discussion.
I hope so.
Yes. So what we're witnessing today is a shift towards something that's called geoeconomics. It's understood as the use of economic tools to advance geopolitical objectives, or the other way around, flexing geopolitical muscle that is then used for economic results. So we're going to be talking about that considering the subject of today, the challenges Europe is facing. Just so you know, if you have any questions for Mark or Koen or both, please do drop them in the comments, because at the end of the session, we'll be coming back to them. Mark, let's go. First question for you. Let's start with the war in Ukraine. How do you see the conflict evolving, and what are the implications for Europe?
Oh my God, I don't live inside Trump's head, huh? So I think that's what it will largely depend on. We know what Putin wants. We know what Ukraine would like to want. We know what we want. Will we get what we want? No, probably not. I hope, and that at the moment seems like the best case scenario, is that we get a European guaranteed strong peace, which means that we will pay the bill for keeping Ukraine not just safe from additional interference and invasion, which is military expenditure and troops on the ground and technology and weaponry and what have you, but also for reconstructing Ukraine into a stable democracy. Obviously also with a trajectory towards joining the European Union in some form or other, sooner rather than later. So that is, if you say geoeconomics determines, or geopolitics determines economics, that's the geopolitical question for Europe. The way the thing will end in Ukraine will determine a lot of what will happen in Europe for the foreseeable future. And if it turns very badly, we will have a boomerang effect of political fragmentation inside the European Union, because then if it turns out badly, basically Russia wins, we will have to ask ourselves, what are we going to do with Russia as Europe? Will we then continue a conflict with Russia where the US wants to normalize relationships? And if so, that will create a lot of political tension and will cost a lot of money, will destabilize certain things, economically speaking. And so there will definitely be, if it turns out badly and Russia wins, a pressure to kind of normalize relationships with Russia again. So there's a lot of big ifs and big questions. But one way or the other, helping Ukraine, reconstruction of Ukraine, paying more into NATO, that's coming in June in The Hague, and then our own defense, so that we don't depend anymore on NATO, that we can decide our own fate, that we don't rely on Mr. Trump anymore. All that together will have to happen. And all that means, of course, a lot of geoeconomics, because it is a translation of geopolitical priorities into industrial and technological priorities that then have to be coordinated through the EU and the states, the member states, at the same time, which is a difficult thing to do.
Maybe because defense policy, we've already mentioned it, of course. What are the economic implications of increased defense spending in Europe?
Well, I think economic implications are pretty clear. It's going to stimulate the economy. But of course, in the beginning, what you're going to see is that quite a big amount of this money is going to go to the United States or going to other countries. And so, yeah, let's see that the return is not going to be that big. So it's, as Mark said, we have to create our own integrated defense industry. That is something that we have to do. That's something that we have to do fast. And of course, the question, can we finance this? Can Belgium, for example, finance this increase from 1.2%, 1.3% to 2.5% of GDP financing in defense? On top of primary deficit that has to be reduced by 0.4% each year for the next 7 years. So it's huge. There, I think we have to look for solutions. There, I think we have to look for solutions on European field. First of all, what you see today, the financing for all this military expenditure is, for the moment, 650 billion on state level, and 150 billion coordinated defense for coordinated defense projects on a European level. Now, the problem with the 650 billion on national state is, of course, that as a country, you're going to spend that probably in Belgium, if you can, to investir, to local firms, because that stimulates your economy the most, and that's for your country the biggest bang for the buck. Mm-hmm. But if you look at on a European level, then that probably is not the best way to spend this money. So I think we really have to think about a pan-European, a European or a pan-European fund that is going to finance these things, maybe with a tax, a European tax. And what is fascinating there is that when you see what is happening today, is that there's a kind of pan-European fund of the willing that is being created. It's not there yet. That involves countries that are not member states, Norway, the UK, and that I think is fantastic. You had Brexit, and all of a sudden they're back in, and yeah, that's a little bit what Mark says in his book, Superstate Europe as well. That all of a sudden this geopolitical reality is trumping economic reality. So that I think is very fascinating, and I think we have to move that way, because otherwise I think with regards to financing and with regards to creating an integrated defense industry is going to be otherwise very, very difficult.
Mm-hmm. You already mentioned Trump, the US. So protectionism, I think, is also interesting to have a little chat about. The risks of protectionism, how do you see this evolving, the position of Europe, the US, China, and so on?
Well, I think the era of globalization is, certainly for hyper-globalization, is finished, that is for sure. In our book, New World Economy, we are talking about multi-globalization. What is multi-globalization? It was a very valid term, I think, until 3-4 months ago. That is that when you're going to export from China to the United States, you don't go directly, just go via Vietnam or Cambodia or other countries, so you don't have to pay tariffs in the United States. Now, of course, with Donald Trump, I don't know what's going to happen, but it could be that he's going to put tariffs on top of all countries, also on Vietnam, on Cambodia, on these intermediate states. And then, part of this multi-globalization is going to be finished. Because whether you go then via Vietnam or Cambodia, you're going to pay extra, that is for sure. Now, a second element, I think what you see is that in a multipolar world, and that is very important, that's where we are today. We have not only China, we not Europe and the United States, but you see India coming up, you see quite a lot of regional political players. I think as a company, you have to take into account that countries like the United States, but as well China, you can't put all your eggs in that bag anymore. Mm-hmm. I think you have to diversify. I think in this multipolar world, you have to have more alliances. And having more alliances means as well that you have to have things to trade with them. Mm-hmm. And in that respect, I think to become a military power is going to help as well. What does it mean for consumers? I think in a multipolar world where globalization is less compared to before, you're going to pay a higher price. You're going to pay a higher price, and I think in the end what we're going to see is a structurally higher inflation and higher interest rates.
So competitiveness will be key and will remain key, but of course there's also things the EU, for instance, can do. Maybe could you maybe elaborate on the clean industrial deal? That will have an impact as well, I suppose.
Look, there's so much that the EU has to do at the same time. We talked about defense. If you look at the agenda for Europe, there isn't any significant sector of the economy, including the financial one, for which the European Union doesn't have an ambition to have a pan-European strategy. So we are in that phase of history where Europe collectively wants to create a bloc that is resilient, strong, vis-à-vis other blocks that are emerging in the world. Industrial base is one of that. And here we pay the price in Europe of a mistake and a crisis. The mistake was the way we did climate policy, which forced upon energy-intensive industry all kinds of additional costs without having to think, is there a model to pay for it? Whether that model is a market or is a government. And now it turns out there isn't. And secondly, the crisis was the energy shock after the invasion in Ukraine, where we had to cut ourselves off Russian gas. So collectively, what does that mean? It means that energy-intensive industry in Europe is basically declining and en route to extinction unless we can support it somehow, either to be competitive globally or to be part of that pan-European autonomy strategy. It's going to be a bit of both. And so the clean industrial deal is a step in that direction. It's first and foremost a recognition of the sense of urgency that Europe is de-industrializing, is losing industrial capacity, some of which we consider to be very strategic and important. And so what is that agenda? It's an agenda that has a lot of sensible goals. It wants to reduce the burden of regulation. It wants to mobilize certain market integration, so infrastructure, for instance, telecommunication, certain integration for finance, so investments for savings and capital. All that is great, but since we are already in a deep acute crisis, for the industrialization. I mean, you have somebody like Mr. Van Poelvoorde, who is the head of Europe for ArcelorMittal, who says this year is the last year of opportunity. If it doesn't happen this year, it's basically over. So the urgency is so big that you really need something immediate. And these measures are not immediate. So what is immediate? Immediate could be that you say we are going to unleash a big sum of money to actually compensate for the cost burden of these industries. And that's then another fund that we want to fund. Just like for defense, we will try to fund a decarbonization fund. Figure is named 100 billion. That's a big question mark. How will that be funded? Who will get it? Which companies, which sectors, under which conditions? So the clean industrial deal is a nice recognition of the fact that we do need to marshal our forces. It will also involve member states. So just like defense, the EU is going to say to member states, it's okay now to do state support, to give taxpayer money, subsidies and all kinds of favors, which normally is not okay in the EU because we have an open market where doing that is distortion and hinders fair competition. So we will allow it for defense and we will allow it for member states to spend it on decarbonization. Now, how is that going to work? And we know, referring to what Koen was saying, we know for Belgium, we don't have any budget margin. So how are we going to keep our industry then competitive when it's actually Europe kind of facilitating an arms race of subsidies for decarbonization? That's a different ballgame altogether to the Europe we were used to work in, which is open competition and the state stays out. So we are small and we can win, even if we're small, because we're good. So I think we will have to watch that very carefully in Belgium and see what actually comes out of it. But the clock is ticking.
And I think it's very dangerous as well if you're going to keep on subsidizing on national level. Yeah, sooner or later, the level playing field is not there anymore. Germany, France, they're way bigger than Belgium is. They have way bigger pockets than we have, certainly Germany. So if we're going to continue on that road, I think sooner or later, Europe and the Eurozone is going to explode.
Germany has now committed itself to put 1 trillion euros on the table, half of which for security, half of which for basically economic revival. And a few years ago, that would have been inconceivable because it's a blatant violation of how we do economics in Europe. Now everybody says, finally the Germans are doing that. So, okay, so hopefully we can profit from a kind of a revival of the German economy. But we had it already under COVID. Under COVID, the EU did the same thing, said you can do subsidies. So what happened in the north of France? France mobilized a lot of capital and gave free energy, nuclear energy, which they have, to say, let's attract in Dunkirk big industry. We'll turn Dunkirk into an industrial port. And we see that the investment went from Flanders to Dunkirk in a number of cases. So if that is the new normal in Europe, we are going to have to think outside the box here in Belgium to actually stay competitive in Europe. Not just for Europe to be competitive, but for us to be competitive in Europe.
You were talking before about the tension between member states v. the union in itself, and maybe could you come back on the thing Mark mentioned about capital?
What do you mean with...
How are we going to finance everything? You were saying action is needed, but of course if the money is not there...
But you have, of course, quite deep pockets of money everywhere. But of course you have to realize them. One of them is the capital market union. Now Barroso was here a couple of weeks ago and he said, yeah, capital market union, you're not going to be able to sell that. Why not? There are politicians that don't like capital, there are politicians that don't like markets, and there are politicians that don't like a union. So now they changed it in a saving and investment union, and now it will pass. So, but that is a good thing, because I think if we see how much risk capital is going every year to the United States, or how many private companies are going to the United States because they can't be financed here, it would be a good thing to instead have 27 capital markets to have one capital market. But it's going to be pretty difficult to realize that. A second element that I think we have to consider is, how are we going to emit Eurobonds? And there, the advantage of Eurobonds, it depends how you do it. If you're going to emit Eurobonds, of course, countries like Belgium, France, Spain, they're going to have to spend less on interest rates. But still, if the European Union is going to lend it to the individual member states, it's weighing on their budget. The only thing how you can make sure that the budget is not gonna be increased, the deficit's not gonna be increased, is to have Eurobonds and then grants to the different member states. But that means that you need some kind of an income in Europe, and that you need some kind of tax. I think that is the way forward, but I think that is a huge step forward, and I don't see, maybe Mark disagrees, but I don't see that happening with Germany, the Netherlands, and quite a lot of other these countries that say, no way, we don't want to do that.
Look, you're absolutely right. That is basically, whether it's for Belgium or for Europe, it's a scramble to find money at scale, and then invest it fast. Fast, which is also an issue. Because, of course, we know permits, is infrastructure available to actually plug it in? Are people available, skilled workers, and so on? It's easy to say, it's actually easier to find the money often than to invest it. So I think it will be all of the above. That's what I think. So what you will see is a high doses of creativity at EU level, somehow to generate funds. We've already seen a few examples, we've mentioned them already, the defense spending, which is very ingenious, because we talked about state aid, but the plan that is on the table is to say 600 billion of state aid at domestic level can go to defense. But to avoid that everybody pays it to their own preferred company, we will actually coordinate it and say how and under which conditions you can do that. So if the Commission is strong enough politically to pull that off, you could do indirectly what you would do with raising a EU tax, is to say we are going to coordinate spending actually from a European level, which is what we need. We need to pool it. the other types of generating funds, tapping into whatever kind of bond reality and so on, it's going to happen. Whether it happens with 27 or it happens with 5 and 2 from outside Europe, it's going to happen. It's already being prepared. The question for our country, for Belgium, is will we be seated at the table to be able to participate? So you will see that. When you say taxes, well, put that into the context of deglobalization. Europe wants to raise taxes on carbon emissions, also imported into Europe from 2026 onward. Tariff wars. If we do tariff wars, and we will have to at some point, it will raise revenue. So you can say that revenue, if we capture that, we will put it directly into certain things. And then you can do all kinds of budget tricks in Europe. Say we're going to, there are pools of money in Europe that are not used. Funds for investment that have not been used. You could say,
we're just sitting there.
Yeah, sitting there. They're on the books. Cohesion funds, COVID recovery fund. Part of it is simply not being spent. So you can say, we redirect it. So and so on and so forth. And you will have the member states doing what Germany does in all kinds of forms and variations. If you can do that with some overall coordination, that it's not every country against each other, I think it can certainly be a significant thing. Is it good enough? That's the big question. Is it going to be good enough compared to the others? What will be the effect of the peace in Ukraine? Question mark. What will Trump actually achieve or destroy in his own economy? And what will that have for implications? Can we leverage the euro? If the dollar is no longer reliable, if people want to cut themselves off from the dollar, can we leverage our eurozone strategically? Can we do that? Can we promote the euro as reserve currency? Can we take that as an opportunity in Europe? Say, that's the way to raise it externally, and so on and so forth. So I don't think there's one magic bullet. I think it will be a continuous effort. And if the pressure, the outside pressure of losing industry, being threatened by the United States, Russia and China at the same time, if that continues, I think you will see a lot of action happening, but not always with 27.
Maybe summarize that you're really calling for action. I think very fast.
Well, yes.
Very fast.
Yeah, it's never fast enough. Yeah? Okay. And Europe is very good in drawing up plans. We've had a lot of planning.
And now it's time to. Yeah. Okay.
Yeah.
Clear. Looking ahead, like 6 to 12 months, what's really urgent? What do you see happening?
There are some big trade-offs that marked. In this new world, there are quite some questions that have to be answered, and I don't say it has to happen between in 6 to 12 months, but we have to decide whether we want to have a more politically integrated Europe, or that we're going to keep the primacy of the nation state. That is one big question that we have to answer. I think the second big question is, are we going to preserve the single market? Are we going to deepen the single market? Or, and if you have a single market, then you need central fiscal capacity. The two go together, so that's a big question as well. And a third element, I think very important as well for the future, is, are we going to keep on being dependent of this export to China, today a little bit less than a couple of years ago, but certainly to the United States. And there I say, okay, let's start to deepen this single market. Let's start to get rid of these internal trade barriers, because maybe you didn't know, but the IMF has calculated that within Europe there are trade barriers equivalent to 44% in the trade of goods and 110% in the trade of services. That is ridiculous. That is ridiculous. If we can avoid these, or we can lower these barriers to the US level of 13%, I know we're going to have much more trade within Europe, much bigger companies with bigger scale, and then we're going to be much more competitive again. So that those are questions that we have to answer as soon as possible. Probably they're not going to be answered in between 6 and 12 months, and I hope between this and a couple of years that we're going to be very clear which direction we go, because otherwise, we risk to blow up this very nice experiment. Yeah.
So if we do enough and fast enough, we will make Europe great again, but maybe let's also talk a bit about Belgium. What are our priorities as a country for Europe's and the challenges ahead?
Look, I've already mentioned it a couple of times. We need to make sure that we position ourselves properly within that new EU reality, which is no longer an open market, but is actually a very much planned state capitalist model where strategic goals are sought after, and where we miss the natural advantage of in that kind of model, which is scale and budget, public money. We mismove, so we will have to maneuver very intelligently. What does that mean? I think we just need to put value on the table as a country. Whether it's in defense, whether it's in industry, all these strategic sectors, they have been identified. Where is the asset that we can put on the table? And that requires industrial policy in Belgium, which is also something we've never done. Industrial policy meaning you identify these strategic sectors, where do we have European champion capacity? We mobilize the government and the private sector, so the industrial players, the technological players, but capital market, because that's where the money is in Belgium. You know, it's the savings, it's the investment, it's the banks, it's the institutional investment. You have to bring these together so there is an investment case, also for defense. And then you can mobilize a fund, and then you try to plug that into EU scale.
Then you get back up.
And then you get back up. That's basically what we need to do. And that's what we at our institute have been pleading for for some time now. So for industrial policy, also in defense, we came out with a paper this week arguing how to do that. And if we do that, and that requires in Belgium, by the way, also a coordination between the federal and the regional in a strategic sense, which is not also part of our political culture. So it's going to be quite a challenging environment for Belgium. And we are running from behind. In defense spending, we have been at the back of the queue for so long that people just ignore us. If we want to be back at the table, we're going to have to do a sprint. Which comes back to the budget challenge. So yeah, it's not an easy position for Belgium to be in, because the old EU and the old world, that was a very comfortable position for us. We didn't have to do a lot of good, strong public governance. We didn't have to do a lot of strategic choice making. We didn't have to pool public resources toward investment. We were just spending our public money. We didn't invest. Our investment is low. And now that world is totally upside down. So for us, it's a real adaptation. But there are very significant opportunities.
Okay,
that's the silver lining.
Let's round it up like that. There are a lot of opportunities. Because, okay, like we said, we're going to pick up with a couple of questions that were in the chat. Mark, maybe one for you first. Someone who says, I think within 3 to 4 years, Europe will lose its stability.
Oh, okay. Look, I'm not a doomsayer, and nobody has a crystal ball, and there are many variables and questions around that before you can make any kind of prediction. But let me put it in economic terms. The political I've already highlighted, the aftermath of Ukraine. Economically, if political stability is maintained economically, there's a lot of untapped potential in Europe. That's the Draghi report, calling for all types of investments, integration of the market, like Koen has said. If we do that, if we do some of that right, I think it will really help. The deglobalization and the fact that Europe wants to build strategic autonomy in a number of industries and technologies will, of course, be an investment case in Europe, of course. So that is another factor for economic growth. And we are still a very significant marketplace and a very deep and rich market. So I think there is real potential. Compared to what other countries when you say we are going to lose and so forth, is America so strong? It remains to be seen. In the short term, Trump is causing a lot of disruption. The markets are not happy. He's going to create inflation probably, and so on. Maybe that will not work. Russia is basically, as an American once told me, it's a gas station with nukes. You know, it's a very small and vulnerable economy. that can survive on hardship, which is the difference with us. So can do a lot of bad things, but it's not a very significant. It's the size of Italy economically. We have engines of growth in Europe as well. You know, don't underestimate what Germany could do with €1 trillion well spent. Don't underestimate what the eastern part of Europe does, Poland and the like. There are growth engines there. So I think we have to be self-confident, but also know that we have things to do if we want to tap into that potential. It's not going to happen by itself.
Okay, it's clear. Yeah. Koen, another question for you maybe. This one is about the position of China regarding Trump's tariffs and its position in the world overall.
Yeah. Yeah, as Mark said, we have things to do, but China has things to do as well. And China is hit pretty hard by the tariffs of Donald Trump. Now, I see two things in China. First of all, this hit is coming just at the time when they are transforming their economy. They are going from an investment-led economy and they want to create a consumption-led economy, which is very, very difficult, certainly if you have a real estate market that is deflating. So that is very, very, very challenging. From the other side, what I see already in China happening is, okay, they used to be the factory of the world and all the international companies were coming there and everything was put together and then they export intermediate goods to these developed countries. Today, what you see is that they have transformed themselves already to the producer of the world and that they have instead of selling everything to the United States and Europe and all these developed countries, they're more and more selling to the global south as well. And they're more and more selling as well finished products. Just look at the electric vehicles, just look at the solar panel. Mm-hmm. It's not anymore the factory of the world, it's the producer of end products of the world that is, first of all, exported to the EU, and that is keeping us at those toes. And second of all, they're effectively exporting it to the global south, and that is their end market. So they are shifting, they were shifting already their export market from the United States to the global south. So they're looking actively for new export markets, and they're really managing to do that.
Okay, clear. Thank you for joining us today, and of course, a massive thank you to Koen and Mark as well. Thank you for being here.
Pleasure.